Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. For those of you that may be joining us for the very first time, welcome. A quick rundown of how TradeFinder works. First of all, before we go any further, if you've seen any of our videos, you're familiar with this. If not, if you haven't seen it before, please take a screenshot of it and read it in detail at your leisure. A couple of important issues that the powers that be want us to make you aware of. Number one, we are not registered to give individual investment advice in the United States. And two, because we have a lot of international viewers, we have a lot of international subscribers, any pricing that we're talking about is assumed to be in US dollars unless noted otherwise. For the rest of it, again, please take a screenshot, read it in detail at your leisure. So the way TradeFinder works is we'll go through and we'll talk a little bit about the market. Then we'll run through and take a look at a case study. Recent one that was closed that I wanted to show you. Actually, it was a loss, but I think that there's a good lesson here. Something that comes up quite often for our newer subscribers. It has to do with our methodology. So I thought I would share that one with you this evening. Then we'll go through and review past open case study considerations. So if you're new, each week we do a search for a case study consideration. The reason I say that, case study consideration versus an alert, is our alert subscribers actually get alerts on entries, any adjustments, and exits. However, when we do TradeFinder, it's a case study consideration. We identify something. We may or may not end up sending it out as an alert to our subscribers, but it's kind of you're on your own. So this is something that we're looking at. This qualifies with our rules if you want to put it on, but we don't necessarily send out alerts on what to do with it. So you make those decisions, whereas our alert subscribers, we give guidance on what we're doing. Again, it's still your money, your account. So you can follow along with our guidance or you can do your own thing. And we have subscribers that do both. Some of them are very well educated, stayed with us for quite a while, and they may tweak a few things differently than what we do, but you can follow along with what we do as well. So just wanted to highlight what the difference between the two was. And so after we review a few, we've had a lot of them closed. If you haven't looked at the past trade finders, please do so. I had a couple subscribers that said they joined because they went back and they looked at the past trade finders, and we're doing these live. It's called TradeFinder Live, and they saw the track record of the alerts that are the case. Even I messed up there. Even the case study considerations that we've identified during TradeFinder and how they've performed. And so anyway, the record speaks for itself. So go back and take a look at it. All right, with that, let's take a quick look at the market. And when we look at the market itself, you can see that we moved to the upside in the last SPY update. So I don't know if you've had a chance to see it or not, but in the last update that I did, we talked about which of these two gaps is going to get filled first. That was going to be the key, right? Because, say it with me, gaps get filled. It's one of our rules that we talk about all the time. We just don't know exactly when. Some get filled rather quickly. Some may take a little bit longer. And we still have one down here. And that's one of those yikes gaps of when's that going to get filled? It will. Statistics say it will at some point in time. But immediately we came up and look at that turnaround. So right as soon as we fill this gap here, now we've started to head back down a bit. So when we see that, we want to look at where's the 10-day moving average. And we broke below that, closed below it today, closed right on the 30-day. I don't look at the 30-day for support. For those of you that might be newer with us, that lime green line is the 10-day moving average, the fuchsia line is the 30, and the royal blue line is the 50-day moving average. The reason I have the 10 and the 30, the 10 is just really important. No security in any time frame is very far away from the 10-day moving average. It's another one of the rules that the subscribers hear about all the time. So we keep that on there, but the 30 is on there because a lot of well-respected traders look at a 10-30 cross for trending. And then the 50-day is for a bit broader range on trending stocks. So the 10-30 can give you a little bit of an early signal on getting in or getting out of a particular trend. And then again, the 50-day is what a lot of people follow to see periodically the market tests the 50-day moving average. So tested it there, tested it again here. Are we coming back down? Or are we going back up? Now remember, we still have one last zigzag that has not quite been had its target hit yet. That's that one right there, 426. And we got awful close, but as I say all the time, these fib levels actually usually get touched. You know, we talked about this back before we got close to 420, that we got up there, we got near it, and then we came back down, and then we actually, so that was back here. We're in the exact same spot. So we had a high of 417.91. We've been calling for 420 for 6 months. If you look at the videos on YouTube, again, that's one of the great things about having those videos posted on YouTube is I can sit here and tell you what it said until I'm blue in the face, but there's the proof. We have it. It's on the web. It's on the internet. You can go back and watch it. You don't have to just assume that what I'm telling you is correct. You can go back and look and see. The proof is there. But when we got up here, I said the same exact thing. Usually the lines get touched, and it didn't look like it was going to, did it? Because we pulled back down. But then we turned around and we actually hit and touched 420, backed off a little bit, moved up, but we didn't quite hit 426. Again, usually the level gets touched. But the caveat here is the fact that, and this important thing to remember, it was with 420 as well, this is an extended level. The zigzag's already done what it was supposed to do. We had a 50% correction. That means 100% extension in the C wave. We've already done that. So what we're looking for now is an extended C wave, and the next target is 161.8. That usually does get touched if it gets that close, but it doesn't have to in order to still be a fulfilled and successful zigzag pattern. So we'll see how that plays out. I wanted to show you that everybody's been asking about the Qs lately, so I thought I would just head that off before we get to the Q&A at the end and go ahead and show this. Now, here's one thing that's pretty interesting. Something has to change here, in my opinion. This is showing a wave 3 with a wave 4 correction here at 33%. Now, the Qs and the SPY can vary. They don't have to move in lockstep, but they're usually not this drastically different, where this is a wave 3 showing just a wave 4 correction, getting ready to make another big run, whereas the SPY is in a wave 5 about to hit its second extended level. So I think that's a key thing to point out again. That main zigzag that hit 420, that was 161.8% extension. So that was already extended. And now the zigzag within the C wave is about to hit its extended level. You getting the key word there. The market is, extended. So we've been showing you the storm clouds in the videos and talking more about them. Gave you some more last week. So it's just something to be aware of. But it's unusual that they're diverging like this. So something's going to relabel here, in my opinion. Now, if you're long the market, you would love to see that wave 5 relabel to a 3. I usually look at the DMI to see, is there enough strength there? Because usually that's a good indicator of whether the 5 is getting ready to relabel or not. But in this case, that's not showing the kind of strength that you would expect to see of a wave 5 that's about to relabel to a wave 3. That looks a lot more like a tired wave 5 that's almost hit its 161.8% extended level. You can see it's at 159%. So it did get within 2%, but I'll stay qualified on the fact that the line usually gets hit. A lot of people could say that's close enough, but and maybe it turns out that way this time, but usually they touch the lines. Here, the ADX is moving down. The sellers are in control a bit here. Buyers backed off today. That's just not the kind of support you see for a wave 5 that's getting ready to switch over to a wave 3. But we'll see. It's going to be interesting to see how this plays out. So I'm going to go ahead and show you, because I wanted to stay with this theme, our case study that I was going to share with you. And it's right here on RRC. Now, as I mentioned to you, I told you it was a loser. You can see we lost 13% on this trade. But we're about to start our Strangle Mastery course. In fact, it starts tomorrow. I have to, maybe support can put a note in there if there's still room I probably shouldn't have brought this up without knowing that answer, but we're going to go into options pricing and valuations. I know it says strangle mastery, so we will talk about the strangle position and triangles, etc. But we're going to talk about delta, gamma, etc. The Greeks that affect how options are priced and how options move in price in relation to the movement of the stock. And a lot of people aren't familiar with how that works. Now, we do things a little bit different at Elliott Wave Options. We do not have a system where if you hit a 50% loss, boom, you're out of the trade. We don't follow that. We stay with the pattern. As long as the pattern is there, we stay with it. And as you can see here, this position was at a 95% loss, almost a complete loss. Also, we're super transparent, by the way. If you're fairly new, we post everything every single day. We have these mark-to-market graphs, so you see where every single alert is every single day. I don't know anybody else that's doing that, honestly. So you can see what happened here. We're down here. We were at a loss for a while, but that was because the stock just really wasn't doing anything. And so we're eroding time value. But then the stock moved as it was supposed to. Look how vertically the pricing of the options moved up from like nothing, just straight up. The stock moved pretty vertically, but so did the options. And that's what's important because we've been in this position for a very long time. You can see 90 days. And the fact that we stayed with the position because we trusted the pattern saved a significant amount of what would have been a 50% loss if you just would have followed that plan and moved on. And we've had a few other ones. We had another one that was the same exact situation as here with just a small loss. We had another one that turned from almost a complete loss into a 30-some% gain. So as long as the pattern's there, we will stay in the last month of expiration. Why do we do that? Because the Greeks work more in your favor. It's counterintuitive, which is why the market makers and the powers that be set it up that way. You think that in the last 30 days, because theta is a negative, but if the position is already eroded, if it's far enough out of the money that the theta decay has already occurred, you don't have any more risk of theta decay. And so if the stock starts to move, then you get the benefit of better gamma, which means better delta, which means better price gaining in the options. So now you're in the last month of expiration. So time decay is no longer an issue. And you're just set with the two Greeks that control the movement of the options. And people it's a lot easier to go market a system. Exit when you make 100% gain or when you have a 50% loss, boom, it's marketable. But it's not, it's a way to slowly bleed out your account. That's what that does. So if you have a system, a technical analysis system that you trust, just because your position may violate that 50% loss rule doesn't necessarily, in my opinion, and our opinion at Elliott Wave Options, just require a trigger finger automatic exit. So here was the entry. Here's what ended up happening. So you can see the chart. You can see we were in a wave 3. So it looked like a nice movement up to 12.5 there is where we're going to go. And you can see the DMI was supportive at the time. Now it took a while, which you'll see in the next chart. And then look at the break that we had. So we had a pretty vertical move to the upside. See, we're just fooling around here for a while. And then we came down and 61.8% wave 4 correction, just classic Fibonacci Elliott wave stuff. And then we moved vertically to the upside. Now, when you see that, you can see there's that separation from the 10-day moving average. So we exited this yesterday. And so we're at a wave 5 that's blown out of the tap box, which is time and price projection. Look how spot on that was. This is a great software program, by the way. I'll tell you a little bit more about that in a few minutes. But the wave 5 had moved outside the tap box. So that means we've exceeded what the price projection was for the wave 5. We're separated from the 10-day moving average, meaning we're overbought. We've gone vertical, which our subscribers could tell you I don't like. I don't like when things go vertically up because quite often when they go vertically up, they come vertically back down. So the question in my mind was, why didn't this 5 relabel to a 3? And remember when I was talking about how when that scenario comes up, I like to look at the DMI. So here we are. Here's the chart. Here's the DMI yesterday, and you're like, doesn't look bad, does it? I mean, that looks pretty darn good. The issue being that the ADX was nearing 35. When you get to 40, usually the strongest part of the run is over. So there's still a little bit of room there. So you could have warranted staying, but we have that overbought condition with the 10-day moving average, and we didn't get a relabeling. Now watch what happened today. So remember, we exited yesterday. So here's today. We moved back lower, finished lower on the day. You can see there was a little bit of a move down in the positive directional indicator, but it was pretty high. The ADX stayed strong, but the 5 relabeled to a 3. So at this point, you might think, well, maybe consider getting back in. And we will watch that, but we're still a bit overbought. So we haven't fully corrected that scenario yet. So we could either go sideways for a while or back down. One of those two things occurs because it will come back to the 10-day moving average. But the other thing to look at is we traded, we were over 14 yesterday, and the target is a little over 16. So it's only a 2-point move. It's kind of in that, it's a lower dollar stock. So it's in that range. It's been benefiting from the craziness. By the way, for those of you that haven't noticed, I'm back in I call it the dragon capsule, back at the main house from being in the mountains. And it was a little scary on the drive home trying to find gas. I'm sure in some areas of you that are listening that you're having that same scenario. But there was lots of gas pumps, and luckily I started looking for gas a little sooner than I usually do because I was concerned about it. But anyway, the Range Resources have been benefiting from that whole scenario that's been going on. And the pipeline's back open. It should start to rectify itself, etc. So how much longer is it going to benefit from it? So I know that's a fundamental argument, and we usually stay with technicals at Elliott Wave Options. But it's kind of, if it pulls back. So here's the final, and I'm going to leave this. The final thought process here, as far as do we stay with this, as far as potentially another new trade, or just move on and forget it, depends on how this gets rectified. If the stock stays here and goes sideways and allows the 10-day moving average to catch up, I'll be less interested because of where the wave 5 target is. However, if we do correct back down to 12 and touch the 10-day moving average there, well, now you've got a bit more room to move back to the upside. That changes the narrative. And so that stays open with a DMI that looks this good, the potential for possibly entering a new position on this one. So I just thought I would go through and share with you the thought process, and we'll see how it plays out. But that's where we are. But the main thing is, we pride ourselves in showing you all our nice gainers, but sometimes you have nice losers. This isn't necessarily a nice loser, but it does show its support of our system at Elliott Wave Options. We're not afraid to have a position break a 50% loss. And if you become a subscriber to our alert service and you go through and you look at our trade history, everything is there. You'll see numerous examples of trades that were worse than a 50% loss and ended up being profitable or at least break even, but definitely better than just accepting the 50% loss and going into the death by 1,000 cuts scenario. Okay, so I was asked on the internet to show Bitcoin. So I'm sure you're going to ask that in the end in the Q&A. So I thought I'd just go ahead and preempt that one as well before we get into looking at our previous case study. So here we go. So what's going on with Bitcoin? Well, we're pulling back. All right, so we had an absolute perfect. If you are interested in trading cryptos, like trading Bitcoin, you got to be looking at Elliott Wave. You have to be. Look how classic this is. The wave 4 right here at 38%. That means a 61.8% extension. it went to 100. That's an extended level, right? So if you have a 38.2% correction on the Fibonacci ratios, that target price is not 100% extension. The target is 61.8. So that means if the target is 61.8, the next or extended level is 100, where I was showing you before, 161.8 was the extended level. Here, 100 is the extended level. So it reached that spot on. And then it came back down. And look, there's another, gaps get filled situation. So we're moving down here. And what you want to look for when you have a wave 5 that extends 100%, and then you start the correction, it went 102. So it kind of gives you normal Elliott wave. And this is, see, we go a lot deeper into Elliott wave stuff at Elliott wave options. We're not just doing the 5-wave directional trend and a 3-wave corrective move after that. That's not us. We break it down into corrective patterns, etc., and we go a little bit further. However, in the realm of the 5-wave corrective patterns, if you don't extend past 100% on the wave 5, your normal target is the previous 4, which would mean coming all the way down here. So we're kind of, 102%, is that enough of a violation of that 100% rule to say that we don't have to come all the way down to the previous 4? I think you need to be aware of that's a potential. The true pure rule, since it was at 102, would be a 61.8% correction, which happens to be right where we are. So if it can hold here around 43,000, somewhere in that area, that could be enough. It also is the top of the previous 3. So you would think there's a bit of support here. We look at the 10-day moving average. You can see that we're a little oversold. So you would expect potentially a bit of at least a hold or a bounce back up on Bitcoin from here. But once it gets back to the 10-day moving average, it's hard to know what's going to happen from there. But then you look and say, well, isn't that a zigzag right there? It's also hit 100% extension. So can you see that we're sitting, the point of this is we're sitting on support of Bitcoin. If it breaks that, it's easy. You're coming down here. If it breaks where we are now, so if it breaks 43,000, we're coming back to the previous 4, which happens to be the 161.8% extension of the current zigzag that it's in as well. So Bitcoin's fairly simple right now. If it holds here, it could turn and run back to the upside and start a new impulse pattern. If it doesn't hold here, then it's, back down towards the 30,000, 31,000 level. So if you're long, which I think 99.9% of people that trade Bitcoin are long, you want to see it hold right here. And it should, because it's got a lot of support. So I wanted to go through that for you. I'm trying to preempt things. People that have watched me do webinars know that I tend to run long. There's prepared material that we need to get through at the end. We'll do as much Q&A as we can, which usually entitles you guys giving us your favorite symbols, and we look at what our indicators say about your favorite symbols, just something for you to consider in your own daily trading. But I tend to run long a lot, and we don't get to all the questions. So I'm trying to head off some of the biggies before we even get into it, just to try to get more questions answered. So here was our case study consideration on Titan International. This goes back to April 6th. As you can see, we had a wave 3 moving forward. So just boom to the upside here. And if we go back to where we were on the entry, we were at 1019. So we hit almost 12. That's not a big move. It's likely that people that may have followed this trade, may be in it, are probably still in it. So you're wondering, okay, we've had a correction. What do? Do we get out? Do we just bail? Or do we stay with it? Well, right now, you're at a 23%. So the 23.6% fib corrective level, that should act as some support, barring a major breakdown in the market. If the market tanks, then most stocks go with it. But if that doesn't happen, it's at a pretty good point of support here. And so you might want to consider hanging in there to see what happens from here. But if it breaks below that, then it becomes a different story. Then you're looking down here in this area. So it did initially go to the upside. In fairness, I'm not sure that was enough move for people that might have been in it to say, hey, that's good enough, I'll go ahead and take the profit. You're likely the majority of people would still be in, but just know that you're at a point of support. And we look at the 10-day moving average, you're a little bit oversold. Again, adding to the idea that that might be at a point of support. Next, we had SAP. This was back on the 13th. And you can see that we had a pretty big move there. And then we pull back. Look what this one is. I mean, these are things that we've identified weeks ago. And here's a 38.2% Fibonacci corrective level for the wave 4. So this one could be going significantly higher as well. It's another major point of support on top of the fact that there's support here too. But it's also at a fib level. So going back, the entry was at 134. And you might have closed that. I mean, I left it open 134 to 143. You might have taken that gain. But if you're still in it, that's what I'm trying to show. If you're still in it, then you're at a point of support. And we may be able to run and break that previous high. So it went up 9 points. That's, just under 10%. So again, everybody has different risk tolerances. Everybody has different profit targets, depending on what you were looking to make on it. Perhaps you exited it, perhaps you didn't. If you didn't, again, maybe hang in there a little bit longer. And then we looked at a strangle on CRE back on 420. So here's where we were. So usually when I look at the strangles, I just take a look at the patterns and take the Elliott wave off. You can see there was a little bit of a head fake to the upside, and the bigger move has been to the downside. We are holding support, and you can see why. Right there was support back in November. If that breaks, though, woo, that could be fun. If you're in this strangle, move down to 60 is possible. There's one of those gaps looming that I'm sure you're looking at. But not a whole lot has happened on this one over the past week. The next one would be DBI from May 4th. Pretty nice looking wave 3 to the upside there. We go back and look at where we were when we identified it, 1878. So even today, it's still above 19, but it got to 20. Would you have taken the gain there? Pretty decent percentage move for a lower dollar stock. If not, we're still in a wave 3. Let's take a look at the DMI. Not the greatest. Would have liked to have seen a little more separation. Not today. Today's move is understandable. Tape was to the downside today, so a little bit of a drop down in the positive directional indicator. Would have liked to have seen a little bit more movement to the upside on the positive directional indicator while this stuff was going on, because that's a pretty nice march to the upside. Would have liked to have seen that have some support shown from the positive directional indicator. It's not there. So that's something to consider as well, as far as if you want to just say, hey, probably basically break even right now. If you didn't take a small gain before, you can hang in there, look at the 10-day moving average. I'd keep a close eye on that DMI. So when you have a scenario like that, then I go to our next favorite, if you will, indicator, which is the CCI. It's a very responsive indicator. It's sensitive to what happens day to day. On the DMI, the two directional indicators are sensitive, but the ADX is a bit more lagging. Takes a little longer to make a move, but the CCI is just, it's like in tune with what's going on every single day. And it's not super exposed as far as being too overbought. There's some room there for it to continue to move back to the upside. So I would say if you're long this one and hadn't gotten out, taken a gain to stay in there. So I'm going to leave this on the list too, because I don't think it's a given that people, I mean, some of the other ones exploded, and so we just took them off. But I don't think this one's a given that people would have taken gains, so we'll keep monitoring it. So here's Southwest, which was another triangle. So strangle pattern. We're looking at that. We've been doing that for our alert subscribers as well. A little bit more on the strangle side of things, because the market is really uncertain right now with being so close to those major resistance levels, and all the warning signs, storm clouds is what we're calling them, instead of warning signals, yellow flags. People talk about caution flags, all those different cliche things that you hear. We're going with storm clouds, but I'm from Florida, so that's my analogy with living here, where we get storm clouds about this time of year every afternoon. So there was a pretty nice looking setup on LUV, and it looked like it was going to break to the downside, and then it came back higher. So no definitive break yet. So that's a false breakout to the downside. Is this going to be a false breakout to the upside? If so, here's what happens. You don't have two head fakes. So you don't have a head fake to the downside and a head fake to the upside. It just doesn't happen. You can get one head fake and then the big move be back in the opposite direction. So in other words, we could add a false breakout or head fake to the downside, and then the big breakout is going to come to the upside. That could very well be what's going on. What I'm saying is the likelihood of that being a downward head fake, this one being an upward one, and then we're going to break down, is a lot less. What usually happens in that scenario is you're forming a larger triangle, which means we could be doing something along these lines. That's still possible, especially with the fact that it tried to break out of that upper trend line today, and it didn't with the softness in the market towards the close. They just kind of moved back down. So it was trying, and that makes you think that the scenario of a larger triangle may be the one here, rather than it's going to run to the upside. I don't know, we'll see. By the time we get together next week, we'll know the answer to that one. And then last week, Darling, clearly see that, and really tried hard to break to the upside. But look, it didn't even hold the breakout day. See, the high was way up here, and then it came back down, and some follow through the next day, a little bit on the following day, but now we're right back to the point of the triangle. The lesson here is people are quick in the strangles, because the average return on a strangle, from our experience, from our history, from our published track record, is 30 to 70%. Well, you know, if you look at this because you have a call and a put, and the stock breaks one direction, the normal thought process is, well, let's take the opposite option off. And so instead of having one option making money and one losing money, take away the one that's losing money, then you only have the one that's making money. But when do you do that? That's the question, right? At what point do you do that? And the risk that you run is that you take that opposite option off too soon, and you get a reversal. Now you're in trouble, because you took your protection off from the other side, and the long option could erode very quickly. And now you just turn what could have been a nice gain into 100% loss really quickly. So you have to be real careful about when you take the opposite leg off. Sometimes we don't ever take it off. We just close the whole position as a whole. So this one had a nice breakout. We're right back down to the point. So you just wait and see what's going to happen here. With Lear, so there was your setup here. You could call that an ascending triangle as well, if you wanted to, which would make sense, but I think either one would be all right. And not much has happened there. PLT, different story. This is what we looked at. We did actually issue this as an alert to our subscribers, and boom, look at that. So with the movement here, the put option has basically brought the position to break even. So it's recovered everything that the call has lost. And so we can watch from here and see where we go following that move. We're right in no man's land here. So we're going to hang with this a little bit longer to see if we don't come down here to support at 25. And if so, that becomes a really, really nicely profitable position. But we'll see how it handles this area here. It's consolidating because it got some massive separation from its 10-day moving average. So that's a rundown of what we've had left over from our previous case studies. Let's go ahead and look for some. Now, last week it was like, all right, let's look at strangles. And I still think we're kind of there. Pardon me. That never happens. I never only sneeze once. So just putting it out there, there's probably another one coming at some point in time. Different pollen out of the mountains back to the beach, different pollen. Now we got palm trees and stuff. All right, so let's look at our pre-computed scans. And this program, I told you I was going to mention more about it if it's new to you. It's called Profitsource, and it's a great Elliott Wave program. I think it's the best one out there. I've tried all the ones that I'm aware of that exist, and this is by far the best, and I'm going to use whichever one I think is the best because I'm a big believer in Elliott Wave. And it's produced by a group called Hub, and they agreed to put our searches in there. So if you happen to be an Elliott Wave Options alert subscriber and you have Profitsource, you get to see these searches here that say EWO. Those are actually my searches that I utilize to find our alerts that we send out to our subscribers in the alert service. So you have the exact searches that I'm looking at every single day. It's a great learning tool because you can go through and look at them and decide for yourself, is this one going to come out as an alert? If it does, okay, or why not? Why didn't it? It's an excellent learning tool. And then there's a few other things here under the Elliott Wave Options. That's for Elliott Wave Options alert service subscribers. Get all these searches in here. Now we're going to go through and show you. So if we look, because right now the impulse is the directional one and doesn't have anything. So it's got 0 listings in there. So let's go look at consolidating. And we can look at the 2 wave 3s because that's a lot. There's 92 stocks that are consolidating. It's too many to look at right now. So let's click on bullish wave 3. Now it adds both filters in there. So we're looking at what stocks are consolidating, but are consolidating within a wave 3. Now you can see right off the bat there's a couple of them right there. There's Love that we're already in. And then there's Darling that we're already in. So let's look at a couple others. I think we looked at Caterpillar last week, if I remember. URI and WSM, I want to look at both of those. MGA, done before too. But let's look at Williams Sonoma. It's not horrible. Would you agree? I mean, you can see that we have a bit of a triangle there, so it's not the worst one. We'll see if we can find something maybe even a little bit better. So what I'm looking at now is support and resistance. Where would we go? We use the width of the mouth of the wedge as a guide, but with this big gap, the question becomes, could this level hold right here at 140? If not, then you could see 120, but 140 might hold based on the level of resistance it was from January, February, and March before it broke up, that was probably an earnings report. If we're at 170, bring down to 140, that still works. That would be enough of a movement. So let's see, I wanted to look at URI as well, United Rental. Look at that. Let's go look at this again. Okay, so there's the ADX on Williams Sonoma. So I really like it when the ADX breaks 13. So it's down there at 12. And then here on United Rentals, you can look at it, you can see it's even just a bit lower. It's heading down towards 10, which the last time it got there, it made a bit of a run. So you want to go back and look at the history as well to see, does the stock move? And I think the answer to that would be yes. Look at that run since the March low. Look at that. From 60 to 340. Wow. And it's still showing it's in a wave 3. But that DMI is not showing that that wave 3 is going to last very long. Now, the issue here is obviously it's a $340 stock. So this is another one where you could kind of make a little bit of a case for a symmetrical triangle. I think the ascending triangle here is a little better structure just because I like touching the line more often. And I think that we're going to find that the options are quite expensive here. We do have an area that we call our high value. So with the high value, we could put this on. Let's see what the options look like here. So looking at our deltas, September would give us plenty of time. Yeah, the spread's 690 by 840. Turn the little magnifier guy on here. So we're looking down here at, there's a 25 delta. Might as well do that since we're going to be in the high value anyway. We could go down to the 21 as well. Let's go over and see what's on the put side. So now we're looking for the minus delta. Yeah, they have both 21 and 25. Isn't that interesting? Notice that they're a bit more expensive on the put side. That's not unusual. But the 280 strike put is 970 by 1190. So this is going to be very expensive to put this on. So for us, it would go in the high value. So we won't use this as a case study consideration for TradeFinder. We'll look for something that's a little less expensive, but this could go depending on what happens tomorrow. And I'm going to see if the spreads tighten just a bit during the trading day. I have an assumption that they will, and do a little more options analysis and see what that looks like. But it's pretty interesting with the fact that the stock has run so far, and we've got this pretty decent symmetrical triangle in a wave 3 that looks like, based on the DMI, is running out of gas. Isn't it interesting that the puts are juiced a bit more? Again, it's usually it's fairly normal for the puts to have more premium in there because everybody knows stocks move down faster than they move up. But are they kind of foretelling that the likelihood is a break to the downside? It's fun when they break to the downside. It really is. All right, so that was some pretty good stuff. So let's see what MGA looks like. We looked at the Signet Jewelers, and the options are not good there. I meant to click this one off. So that ADX is just getting down to 13. Another one of those that's in a wave 3 and consolidating, and it just doesn't look very supportive from the DMI, does it, as far as a continued run. So these two wave 3s could be getting ready to create their wave 4. That looks pretty good too. Maybe a little less expensive. Let's see. So we have September again. That's good. Yeah, much less expensive. So let's turn a little magnifier guy back on here. So 21 to 28 delta, but either one of them look okay price-wise. So let's go see what the put side looks like. Let me get this thing out of here. So look down through the puts. Yeah, get 24 and 28. That one looks pretty good. And that one we can keep right around our $500 of risk. So let's put that down as one case study consideration for this week. MGA strangle. And we don't want to just give complete preference to the long side. So now let's switch this. I mean, there's a couple more that we didn't look at, but in the effort to save some time here. Nothing's consolidating on the way down. Now that's not unusual. If you're wondering, well, you're telling me that out of 92 consolidating stocks, not one of them is consolidating, bearish wave 3 that has 138 stocks. It's not unusual. We know how things move to the downside. And they don't necessarily move down and consolidate and then move down again like things do when they move to the upside. So that's not unusual, but it was worth taking a look at. We'll look and see if we've got a couple more maybe we can take a quick look at, and then we'll take a few questions. Honda. Not much there, is there? That's another thing that with the search, when you're looking for consolidating stocks, you don't always find triangles. Sometimes you have a sideways consolidation, which is what we have here, which is a channeling effect. Not what we want for triangle breakouts. BMR I've done before. Low ADX. Wave 5 meaning, but that's not really much of a triangle either. Let's see if we can find a better constructed triangle. Look at these banks. That's interesting. We're getting a few of the closer I've done before. Let's see if we can find a bank one. There's KBE. Let's look at that. Let's just look at the ETF. Well, maybe it's a little bigger than I thought. I didn't think it was a big enough triangle, but 50 to 55, it's dead on. So when I say that, we're looking for the mouth of the triangle, the widest part from there to be 10% of the stock price. That's what you're looking for. So if the stock is at 55, then you're looking for the mouth of the wedge for a 10% move. So 5.5 points, and we're kind of pretty darn close with, if you count that as 49.5 there, we're right about 5.5 points. So that's our 10% dead on. It's nice when you have more than that, but there was a pretty good run here in the banks that are consolidating. Let's look at a couple individual banks before we decide on that one, but that looks pretty good. East West Bancorp, done before. It's the same pattern, isn't it? So, I mean, that makes sense. Maybe we're going to find that with First Republic as well. If we're going to see that, we might as well go with the ETF. It's not going to be good for the market if all these banks are looking tired like this. That is not something that is constructive for a market going higher, at least in the short term. Financials need to lead. Let's try MTB. All right, we're going to just stay with, we're going to put that down as well. The KBE for a strangle too. And then over on the side, I'm going to make a note for the high value thing on URI. That's a pretty big run that it's had since the lows of last March. If the market starts to get a little squirrely, that's a stock that any investment managers that are holding will start to dump quickly to take the profits, to lock in those gains. And also it's a higher dollar stock, so it generates more cash than selling off a $50 stock does. So there's a couple reasons there why that looks really attractive, especially if the market does correct. Even if the market doesn't correct, if that stock corrects, it's set up pretty well for a decent move to the downside, a decent corrective move. All right, so let me take a few questions and then we'll wrap things up. Andrew is asking about GLD, which we are currently long for our subscribers. And the question is, do I think it's going to make it through 175? Just remember that, and I say this a lot, but remember the market doesn't care what I think. Nobody really cares what I think. Hopefully the subscribers do, but the market certainly doesn't care what I think. What I'm looking at here is what are the indicators saying, and I really like the way that DMI is set up. I know it's been a pretty decent run. Finally, we've been waiting for this for quite a while. Hard to understand why gold hadn't done this sooner, in my opinion. Pardon me. So it finally broke 165, tested it. Now we're at 175. If we can break that, now we have something. If we break that, we could be looking quickly at 195. So that's what I'm saying. Now you have something. Hey, another 20-point run out of it. Well, look at the DMI. Could it be setting up any better? For me, it's perfect already. And the reason I say that is I like to look at an ADX that's breaking up above 20. Other people, and if you get on the internet and read about the DMI as a technical indicator, we'll talk about having the ADX crossing up above 25. Between the two directional indicators, whichever directional indicator is on top is usually the direction it's moving, because the ADX doesn't show you direction. The ADX measures strength of that directional move. So right now, the positive directional indicator is telling us it's an upward move, and the ADX is telling us that there is strength behind that. We have a TradeScan series on our website, lots of good information, educational information on our website, but we talk about all of our confirming indicators that we use along with Elliott Wave. There's a whole session on pretty much each of our individual indicators. The DMI is one of the favored ones. Setting it up that way, I like to see the ADX breaking above 20. I think you can be a touch more aggressive. Very rarely do you have a setup that looks this good with the ADX breaking above 20 that doesn't break above 25. So if you get in a little bit sooner, you get a little bit more of the stronger part of the move, if you will. So to answer your question, Andrew, based on the DMI, it looks good for gold to break through that 175 level. And then really, I mean, there's some resistance there at 180, not a whole lot. That could really set in some short covering on gold, maybe even some big short covering from like the Federal Reserve that shorts gold could really be moving. Lydia asked for the tap levels, but remember this is in a wave 5 to the downside, but that DMI is supporting this relabeling. And if it breaks above that 175 level, especially right now we're at the 61.8% level, it would relabel that to probably a wave 3 moving to the upside. So we have to be wary that there's still a qualified wave 5 pattern to the downside. But when we have something like this, when you look and you see a DMI that's that strong, it's difficult to imagine that that downward pattern is going to hold. This would have to just completely fall apart. Maybe it will. And maybe that 61.8% fib level at resistance at 175 holds. That's possible that it occurs. The suggestion from the DMI is that we're going to break through that. It's going to be very interesting. So, you know, ask these same questions next week because we'll know a whole lot more then, won't we? Brian is asking about FCEL. Says it looks to have no support, so is a put reasonable, especially with the triple Qs showing weakness. Let's take a look. And there was a triangle there. And so we're kind of back, because that's not the greatest area of support, a recent triangle. It does show that that's where some consolidation was. So it's not the greatest. When you have a triangle, you showed some consolidation, but it's not like a really good support resistance line. It is trying to build one here though, because it's holding this level. It came down, bounced back up, then tried to break below it, bounced back above it. So it's really trying. I'm guessing that there's some institutions that are in this that are trying to buy a bit more and see if they can spur some short covering and get a bounce out of this. If they can't, then see, here's the thing to be leery of, Brian, is the institutions. If they can't hold it here, it comes all the way back down here to 2.5, and they have to dump. Anything other than a very aggressive, as far as their objective, would have to, investment objective would have to sell, because only those that are registered as being very aggressive can own stuff under $5. And it's a very limited number. And it's even, there's more under 10, but under 5 is pretty brutal for almost all investment managers. So they're not going to want to see that come down and threaten that. But if it does, then you'll see that 2.5 because they'll have to sell. So I would be cautious of this one right here. As far as a put, I would be more apt to consider a strangle doing a call and a put, considering it's not a great triangle, but considering that it's really trying to hold this level and you have a decent amount of room. I see why you're asking about a put, because yeah, if it doesn't hold here, then that's a quick move down. That would be great for a put. I'm a little concerned about the institutional aspect here. They can come in if they choose to step in and buy more and force some of the weaker shorts out, and you get a bit of a short covering rally. So that's a concern there. Tom wants to look at MATW. I like the triangle look. The ADX isn't quite low. That's why it's not on our search. That's one of the indicators on finding consolidated stocks. Now, to qualify that, you don't have to have a low ADX to have a good triangle pattern that breaks out. The low ADX is not a requirement. What the low ADX does is tell you if the ADX has gotten down to 13 or below, it's been consolidating for a while. And the likelihood, if it's been consolidating for a while, is what? That it's going to break out, right? So the likelihood is that it's going to break out sooner rather than later. That's important when we have put a strangle on, because we're buying a call and buying a put. We've got time decay issues on both sides. However, there are plenty that never see that low of an ADX and break out. On the other side of the coin, though, there are some that look like they're ready to break out, and then they just chop for a while until that ADX goes down. One real interesting thing about this one is that's a nice looking doji right there. And when you have a nice doji right at the point of a triangle, that could be getting ready to break out. I'm not really familiar with this one, so I don't know about the options. Let's just take a quick look here. I'll just do a quick perusal here of what the options look like. Yeah, see, there's not a whole lot of strikes. See how wide the spreads are? It'll be really challenging unless those tighten up during the trading. They're over $2 wide. That was 170. They may tighten up during trade tomorrow, but right now that looks a little bit wide, but that's a great looking triangle setup. So yeah, good call there. Separately shorting Disney. Is that Scott DIS talking about Disney? Well, if it breaks 170, we're going to come fill this gap, and there's two of them, right? I mean, that's what you're looking at there. Boom, boom. But there's support right here, so it has to break that if you're going to whoever's shorting this. But I really like the triangle. Look at that one. Where's the ADX here? And that's interesting, isn't it? Because there was some support here at 182. This is a pretty interesting one to look at. At 180, you can see there's support resistance, right? It was resistance back at the end of last year and then support ever since. Had a doji, boom, broke it. Now we're down at 170, but the ADX was like, yeah, there was some strength to that movement. That's not good for the market either if Disney breaks down. That's just not good. So if you're long the market, you want to see Disney hold this 170 level. If it can't hold it, then there's room for a pretty good fall here. You're at least going to get this gap, I would think, on a break of 170 probably pretty quickly. And then it might say, while it's at it, let's just come down in and get this one done too. So yeah, there's some issues there. So thanks for pointing that out. Alexander, you asked about the GLD and the weekly chart. Is it you that does it every week, or we'll look at it again real quick? Seems like someone's asked that exact same thing the last few times. So there's the weekly chart. It's showing even better as far as an Elliott Wave pattern to the upside, because remember on the daily chart it's showing an Elliott Wave pattern to the downside that I was surmising is going to relabel. But right here it looks like just a great wave 4 moving to the upside. We don't have a qualifying DMI yet, but it could be setting up. That means nothing. Don't ever get caught up in, okay, it's getting ready to set up, it looks good, it's going to happen, so I go in. You have to let the indicator give you the signal. There's head fakes in technical indicators all the time. It looks like it could be, but until it does, you can't view it that way. But you can certainly go back and look at that DMI on the daily chart, which looks stellar. JMIA. Jumia Technologies. And just kind of stuck a toe in the water. You don't see this very often. There is support there at 20, but look, it just went boop. Oh, okay, we tested it. Just touch it, little toe in the water, touched it. Now we're moving back to the upside. But man, that is one big descending triangle, isn't it? It's huge. And it looks like it's trying to break out. So, you know, if the technology stuff breaks out, then that's a little bit more supportive for the market. But let's see where the 10-day moving average is. Do we get oversold? It's back above it though. That's looking pretty interesting. I mean, that's been hurt so bad. Maybe some potential upside left to go there. But 20 is support. That's just humorous to me. It just tested it, boom, like, and then off we go. Qualcomm. We'll look at this one Thursday night, obviously. And it's just the issue here with 130. What it does from here is going to tell a lot. It's major point of support and resistance. As you can see, resistance back at the end of the year, support ever since. Still see this gap up here that at some point is going to get filled. If we start to see some life in technology, maybe the market does turn around and run up. That would be pretty impressive in my opinion, but the market has done some impressive things in the past as well. But there's a gap there still in Qualcomm. If it doesn't hold, if it breaks below 130, which we've been watching, obviously, you're quickly to 110. So if we can't hold 130, you're probably in a week at 110. And then if you're coming down to 110, it might start eyeing that gap. And the market makers might start looking at that and say, all right, how can we get that gap covered? Because they're likely holding positions here. They hedge them off, but they're still holding them, and they don't like to do that. They want them out. That's why gaps get filled. We'll do more on that another time. Viacom, and then we're going to wrap things up here. Went over the hour, so Viacom. Is really trying to catch a bid. That is some serious consolidation right there. Following the drop, looking at speculation there of a bounce back. That hasn't happened yet, but it's trying. It's above the 10-day moving average. And we had Doji a couple of days ago, and they tried to break out, couldn't hold it. Tried again today, a little more success today. And there was some, competition news out there that they thought was maybe going to have to whip Viacom into shape in order to stay competitive. So maybe that's why there was a little bit of a bid, thinking that Viacom may announce some news. Now, just like we talked about the triangle, what was it? Was it Fuel Cell? Yeah, Fuel Cell that had the triangle that was kind of acting as support. Viacom here, looking at this, has its triangle breakout back up here right about 52, which would be a nice break to the upside. That would be a really good bullish trade if that were to occur. All right, so appreciate your time as always. The TradeFinder, hope you found this informative. Hope you come back with us week after week. If you're interested in our alert service, you can go to our website at ewotrader.com, ewotrader.com, and there you can find out information on the alert service. Thanks as always for your time. Hope you have a great week. Look forward to talking again next week. Take care, everybody.